Okay, without any further ado, let's now go to Simon Pressley of Propertyology. Simon, thanks for joining us.
My pleasure, Peter. Always good to have a chat.
Yeah. Now, we've talked about lots of things over the years, and we've looked at, some of the prevailing ideas in the property market. And I have often found that you disagree with, like, the views that people have about property. And so today I want to actually talk to you about what is it you think people get wrong and what is the right view to have about property. And let me say, concentrate on your beloved Brisbane, because it's seen as being a good place to be. It's had a good run for the last few years. Tell me if I'm wrong, but it seems like Brisbane's been a popular place to be. At one stage, I thought there was a bit of like a commitment to that great march into southeast Queensland when Peter Beattie was premier and prices were going through the roof. And you might tell me where it was wrong, but it just seems to me, and let's face it, 3 or 4 years ago, Brisbane really did look fantastic value. I was watching those shows, Love It or Listed or whatever it might be. People were selling in Melbourne and then buying great places in Brisbane with pools just like you, all that sort of stuff. So put us right when it comes to understanding how you make money out of property.
Yeah, contrarian, I think, is what you describe me as, and I get that a lot. It's not at all that I like being different. What I like is understanding the cause and effect of things. Someone once described it as the science brain. I'm not a scientist, but it is important to me to understand the cause and effect of things. And my role, regardless of the fact I live in Brisbane, my role is to look at each of the 400 towns and cities across Australia every single day and understand what's happening, mostly with their economy, because evidence-based studies have taught me that the cause and effect of property market performance is mostly influenced by economic performance of that individual town or city. So that's why in almost every single year, Peter, there'll be some parts of Australia that might have had 10 to 15% increase in median house values. There'll be some other locations that had no increase at all. And there'll be some others that have gone backwards. They've all had the same interest rates. They've all had the same prime minister, but yet their property markets have been very, very different. So it's an economic story. But what I know, I've forced myself to gather the evidence and study it for years and years and years. Now, there's nowhere in the world that people can elect to learn that. There's no university degree or course that I would describe as good quality information, or a book that I would describe as good quality information. So that's, I guess, why I see things differently, is because it's very much evidence-based learning.
So, we see every month the newspapers, the chief economists, they look at the house price changes on the month and they look at the annual change. How important is that as an indicator for anyone who is either wanting to buy their first property or be an upgrader or be an investor? Really, what do you think about that as an important indicator?
I think it very much depends on whether you are buying to live in the property, that is a home, or whether you're buying it as an investor. If you're buying an investor, you need to have more the mentality of the share investor, and you need to disregard home, and you need to see property as a financial instrument. If you're looking to buy a property to live in, whether it's your first home, whether you're upgrading to something bigger or nicer, or downsizing because you're an empty nester or whatever, I would say it's largely irrelevant what's happening in the world, because what's most important for the home is what's going to make you happy. And the town or city and the individual property within it is very different to what makes Peter happy, Simon happy, or Bill Bloggs happy. If you are an investor, you need to totally disregard where you bloody live, and you need to forget about the bricks and the mortar and the capital city versus region and coastal versus inland. And you need to learn from the evidence-based studies I was talking about before that we've got 8 capital cities and 400 regions across 8 states. And what will have the single biggest influence on property market performance is the actions that influence the economy of each of those towns and cities in the future. So I really don't care about, for example, an unemployment rate. Right? That's irrelevant to me. There's lots of different ways of measuring an economy, but at the end of the day, there's a big bunch of decisions that different stakeholders of a community make, federal government, state government, city council, existing businesses, China, Japan, America, etc. There's lots of decisions that are made each year that have an impact either on job creation or job loss. And they're the things that people need to focus on, not bricks and mortar and train stations and shopping centres and cafes. Those things are important for home, but have nothing at all to do with market performance.
Okay, so you said there's effectively 400 economies to care about because there's
Yeah.
400 cities and towns you watch, and you said that unemployment's not important. And I guess here is a question relevant to all this. And when people ask me, when do I think house prices will fall? I usually say, well, if we saw unemployment at 10%, probably we'd see a lot of house price falling. What do you reckon? You know, I'm saying as an economist and as a historian as well, the last time we were 10% house prices, they fell, but they didn't fall by a real lot. You know, I'm talking about 1990, 91, unemployment got to 10.4%. That was national. Around the country, it's probably even higher in some of those places you're talking about. But we need a serious spike in unemployment to see pretty well a national fall in house prices?
Yes, but it's not about a specific figure of 10% unemployment or 7% or anything like that. It's job creation and job loss, and more what the trend is doing. I mean, obviously, now and for the last sort of 5 or 6 years, Australia has enjoyed incredibly low unemployment rates, and broadly think that's likely to increase, but nothing alarmingly. But it's only going to have a tangible impact on property markets. And again, it's not about the Australian unemployment rate or the New South Wales versus Queensland unemployment rate, because you can't actually buy property in an Australian property index or a New South Wales property index. It doesn't exist. So it's about the individual town or city. But if there is a significant increase in jobs or a significant loss in jobs in an individual town or city, it will directly flow through to the property market performance of that individual town or city.
Okay. Simon, you probably remember when Bob Carr was Premier in New South Wales and Michael Egan was Treasurer, they introduced about 3 taxes that really hurt the property market, and Sydney house prices went sort of sideways for, I can't remember how, but it seemed like 3 or 4 years, could have even been longer. I remember interviewing John Simon for a big Commonwealth Bank conference, and at the time, it was going sideways. Can you recall that time? And can government policy have a big impact on a capital city for a period of time?
Definitely, state governments can and do regularly. They have a lot more influence on property market performance than federal governments, because they have a lot more power. COVID was a reminder of that. What ScoMo wanted to do in COVID was overruled by what the Premier wanted to do and did in fact do. It's the same with economies. States have a lot more taxes, particularly property taxes, and they have a much greater influence over things like infrastructure investment and broader economic policy. Right now, for example, the state of Victoria, most people would be oblivious to the fact that Melbourne's median house price today is only 3% higher than 7 years ago. Over that 7 years, is parts of Australia where house prices have doubled, right? Melbourne's had 3% growth in 7 years. There's no coincidence that the whole state of Victoria has been an economic basket case for much of that period of time. And the biggest influence over the current economic basket case is a long suite of really poor decisions made by the Victorian state government. Every state in Australia has had periods, sadly, like that. This time 10 years ago, Western Australia was entering economic doldrums. Queensland and South Australia weren't doing much at all. Their economies. New South Wales had periods before where their premier was like a revolving door. I think you had 6 premiers in about a decade or something like that. So the performance, good or bad, of a state government has a very, very big impact on the broader state, not just the capital city, but the broader state's property market performances.
Yeah. How important is the poor supply of houses nationally important to the fact that we've had big rises in house prices nationally?
That is very important. Like demand, supply and demand are very misunderstood with property. The masses believe that demand is population growth. It's not. Whether we're talking about property, food, clothing, or cars. And demand is a human electing to use money to buy something. And most people who buy property are already living there. It's the existing resident population who transact in property most, not the 50% of increase in population each year. On the supply side of things, I think a lot of people think that's all about how many new homes are built. It's part of the equation, but the single biggest influence on the supply side of property market performance is how many properties are listed for sale. Most properties that are transacted in any town or city in any year, Peter, are an established dwelling, whether we're talking about an owner-occupier or an investor. When they work out exactly what is it that I want to buy, more often than not, it's an established dwelling somewhere that ticks the boxes they're looking for. Now, right now, Australia today has 25% less properties listed for sale than this time 7 years ago. We've had a 3 million increase in our population over the last 7 years, but yet there's 25% fewer properties listed for sale. So what that means is if you're a buyer, investor or owner-occupier, doesn't matter, it's all competition at the end of the day. If you're a buyer, you're competing much harder than you used to because there's fewer properties listed for sale. The governments can do whatever they want or say whatever they want in terms of building more. Evidence suggests that governments only themselves fund about 1% of new properties each year. It's the private sector that fund them. But at the end of the day, it's the general public that buy them. So build very little or build a lot. But if the buyer doesn't want it, whether it's new or established, they won't buy it.
Mm. What do you think about people who say to young people, look, rent where you want to live and then invest where you can make some money, well, where one day you might want to live, but at this point in time, you can't afford to live there. Use a tax office to help you pay for it. What do you think of that strategy?
Yeah, it's become increasingly common, but particularly for the person who might be, I'm generalising here, but someone in their mid-30s who lives in a very expensive city such as Sydney. It's not that they don't want to own a home, but we're talking about earlier, the supply and number of properties on the market. So when they look at what's available and then compare whether they want to live in it and can they afford it, they quickly conclude, no, I can't. But it doesn't mean they can't buy a property, right? So rather than have, for example, $100,000 cash in the bank saved as a deposit, and then sort of feel depressed that that's not enough money to buy the 3 or 4 bedroom house in Sydney that they really want to live in, there'd be somewhere in Australia that you can put that $100,000 into a property, hopefully in a well-chosen location, considering all those 400 towns and cities. And if you get that decision right, at 100 grand combined with the debt is going to grow at a much bigger rate than what that same person can continue to add their savings to. So it's called rentvesting. As I said, it's very common for that middle 30s couple, but it's always been around. There are some occupations who need to be more mobile for career progression. That think of the military or engineers or something like that. They might not want to anchor themselves to a particular city and buy a home in it. They might be happily renting because renting means they've got the flexibility of moving. So they can move around to wherever they want with their employment, but they still own property. They just don't have to be living in that property. They might have a property portfolio of 3 or 4 properties spread around Australia.
Mm. What about investing in property in a self-managed super fund? I know 8 years ago it was very good. There was no interest rates were quite good. There was less government impositions on people doing that. What do you think about nowadays? Self-managed.
There's nothing wrong with it. But people still need to know the rules. Just because someone can set up a fund, it doesn't mean that they should. There's no law stopping someone setting up, but do they have the skills? I'm a big advocate. If they're going to set up a fund, you still need to have a really, really close relationship with a trusted financial advisor, and lean on them to make good quality decisions. There are a lot of people who set up self-managed super funds and then the money burns a hole in their pocket, and they make some pretty reckless decisions with the property that they've sold. So the property that they bought. Well, I think one thing that people who enter the self-managed superannuation space need to be more aware of is the annual holding costs of buying a property through a self-managed super fund compared to buying that same property in your own name, the difference is significant. A self-managed superannuation fund must have a principal and interest loan structure, whereas most investors in their personal name will have it on an interest-only structure. And then the interest rate itself, the self-managed super fund loan typically has an extra 2% buffer. So a stereotypical property owned outside super might cost the investor, let's say, $15,000 to $20,000 of their own money per year. That same property inside super is probably going to be about $35,000 that the fund has to find. So that catches a lot of people out.
Can you run through what you hear out there that's being peddled in the media that people should understand about property, where you say, "Oh, no, that is just wrong. That is wrong. If people believe that, they're going to be making the wrong decision because of that."
Population growth is the most common one, and I think I've done that to death on your show. So your listeners will be aware that population growth has a very, very small influence. The next biggest myth would be that capital city and region have something to do with rates of growth or something to do with risk. It doesn't. They're just useless terms in terms of markets and in terms of performance. There are some regions that are high risk, and I would discourage anyone from investing in. But there are dozens and dozens of them that actually have a lower risk profile than 8 out of 8 capital cities. So it's got nothing to do with capital versus region. It's like a share investor saying banking stocks are more risky than a tech stock or vice versa. Well, which banking stock are you talking about, and which technology company are you talking about? So that would be the biggest. And then because we live in property, a lot of people's perceptions are based on how they feel themselves. So the person who likes being near water, for example, I do, but I also know that water has nothing to do with property market performance. A lot of people who like water will end up buying somewhere near the water, thinking somehow that's going to make it grow more than if they bought in an inland location. It has no bearing on it whatsoever.
The fact is, people all want to live near the water, and most people do. Are you arguing that they pay a higher price to get in there, and then as a consequence of that, the growth is not all that great compared to an inland place where you might buy cheap?
Well, I think if we did a survey of 27 million Australians, a very, very high portion would say, yes, I do. I would prefer to live in the water. But then if we did a separate survey and said, well, are you actually living there? Most people wouldn't, right? So there is a difference between a house that literally is on the coastline and bang, they can see the blue water, 24 hours of the day, compared to someone saying, look, I live in Sydney, and Sydney is technically a coastal city, but my home is in Penrith, right, which is a long way near the beach. So water doesn't have anything to do with the market.
Okay. When it comes to stocks, I love buying great quality stocks when the market hates them. Like at the moment, I like CSL, and I like Xero, and I like NextDC, because the market at the moment is being negative, but they're quality companies. Now, Byron Bay, it's got quality assets often, but at the moment it's come off the boil. But before then, it was really rocketing, wasn't it, during COVID and all that sort of stuff? So is that a good place to buy when it comes off the boil because of prices are high or interest rates are rising? Can you apply the same kind of principle to properties when prices are falling for good quality areas?
In a word, no. Yeah, well, but main reason being is property is not tradable like shares are, right? You and I know that we can press a few keys on the keyboard and we can buy or sell some stocks literally within seconds. Property's not like that. Market performance is probably think more like not the share value, but think about the profit loss statement of a company or the performance of a footy team. Property market performance, it's a sum of the inputs. There is no, markets don't bounce in property. They can in shares because sentiment can drive stocks up or down literally within a few hours. But property markets don't do that. It's all those economic inputs. And most of those things that have a big influence on market performance, there can be a lead time of several years. So, I wouldn't encourage anyone to be buying properties that way.
Okay, last question, and this really relates back to what happened in the GFC. In the GFC, Palm Beach, before the GFC was just, Palm Beach in Sydney was rocketing. Values were really high. And then GFC, a lot of the people from Macquarie Bank and BT and all the other big investment banks were in trouble and prices fell. They fell really hard. You might recall that.
Yep.
A city that has often been like has been the Gold Coast. Up one day and really could fall. But Gold Coast seems, and you can correct me if I'm wrong, seems as though it's got out of that boom and bust cycle. Is all the things I said true?
Yes, it is true. And back in the day, Gold Coast, look, for a long time, it's had some economic diversity, but nowhere near enough for Propertyology's liking. And the problem with a town or city, if its economy depends too heavily on one key sector, whenever that one key sector has a downturn, which often is globally influenced, that city that depends on it more, its property market suffers more than somewhere else. So Gold Coast is an example of a city that now has incredible economic diversity. But if we went back to, as early as, say, 2005 and every year beyond that, it depended too heavily on tourism. So when, and tourism's a discretionary expense. So when broadly the Australian economy is good, people are holidaying the Gold Coast and the local economy is doing well. But when the GFC hit, which is a great example you use, discretionary spending tightens. People don't go on holidays, Gold Coast suffers. A modern day example of what you're talking about there is Perth. Perth has some economic diversity, but it depends too heavily on mining. So whenever it is the mining industry has a downturn, which it will at some point down the track, whenever it does, whilst the mines aren't in Perth, tens of billions of dollars of revenue comes directly from mining royalties into Perth's economy every single year. So, economic diversity is the single most important thing for mitigating risk as a property investor.
And people who have bought, what's that big area south of Perth, begins with
Mandurah?
Exactly. Mandurah. People have bought there low and have absolutely killed them when the mining boom's on, and then it's really fallen, hasn't it? There's a classic example of they're good quality assets, but you have to buy them at the right time ahead of another mining boom, and they go up in value quite extraordinarily.
Yeah, and with 8 billion people on the planet, Peter, there's no individual who's got any way of knowing when each industry sector is going to have its downturn. So anyone who's got some interest in investing in property, don't pretend that you can predict what industries are going to have a downturn. Be more sensible and only invest in towns or cities that have significant economic diversity. And make sure you're aware that capital city or region has nothing at all to do with economic diversity.
Yeah, I remember one stage, and you recall this, where I think apartments in Gunnedah were unbelievably expensive because the coal mining industry was absolutely killing it. And once everyone started hating coal, guess what? Gunnedah was a very cheap place to buy.
Yeah, that's a good example. It's not coal or mining that made the boom. It's job creation. It's always an economic story.
Yeah. Simon, thanks for joining us, mate. Great insight.
My pleasure. At any time.